Hello and welcome to my channel, The Quality Investor. With earnings season in full swing, I've been providing commentary on my various holdings as well as some other stocks that I've been watching. This is a way for me to assess if my investment thesis remains intact if it's a stock that I hold. Yesterday morning, MSCI, ticker MSCI, released their full year 2023 earnings. And well, it was pretty impressive. Their top line revenue crushed Wall Street expectations by over 11%, finishing 2023 with a very strong 20% year-over-year revenue growth from Q4. In my view, MSCI is a nearly perfect business. It generates revenue from a subscription-based model as well as asset fee-based model from their ETFs. So my investment thesis for MSCI is simple. Point 1, they have a subscription and asset fee-based revenue model, which drives up margins and creates predictable cash flows. Point 2, they are also an indexing global leader along with S&P Global, meaning ETFs and mutual funds use MSCI as the index benchmark for their performance. When it comes to MSCI's ESG ETF segment, however, MSCI is the clear market leader with over 56% market share. ESG is the fastest growing segment. And point 3, this, along with their analytics platform, create high switching costs for their clients. Once a client chooses MSCI, that fund uses their index benchmark for years. On the analytics side, reconfiguring their trading and analytics platforms is just too cumbersome. All right, let's get into the earnings. But first, if you enjoy content like this, please hit that like button and subscribe to the channel. Also, please share this video and also hit that notification bell so you can know right away when I post more stock analysis content. Okay, so we're looking at a summary of MSCI's income statement here, and you can see that very impressive growth. So the operating revenues up 19.8% year over year on the 3 months quarter ended. And on the year ended, that's a nice 12.5% year-over-year increase. And what I really like to see is margin expansion. You can see here their operating margin expanded from 53.7 last year to 54.8 this year. They also had very impressive earnings per share growth. Their diluted earnings per share was $14.39, representing a 34% increase year over year. And one of MSCI's biggest strengths is that they reward shareholders. You can see they increased their dividend in the fourth quarter by 15.9%, a very healthy dividend increase. And they also repurchased nearly 1 million shares throughout 2023 and through January 29th of this year at a price of $468.26. Consider that they're trading at over $600 in the market right now. I wanted to quickly point out their full year 2024 guidance. There's nothing on here that's particularly stunning. It's, I think, a pretty average growth in line with what they've done historically. The important thing is their free cash flow guidance here, $1.2 billion to $1.285 billion. Again, that's representing more growth in their free cash flow, which is what we as shareholders really want. And coming over to their summary of the balance sheet and cash flow items, a couple things caught my eye that made me research a little bit deeper. First off, their cash equivalents is down pretty significantly from 2022. From nearly $1 billion in cash down to $461.6 million in cash. However, their deferred revenue is over $1 billion now, up from $882 million at 2022. Now, deferred revenue is essentially revenue items that they expect to recognize later in the year, but due to GAAP accounting rules, they can't recognize that revenue today. So that's roughly 40% of their 2023 revenue is $1 billion. So that's a lot of deferred revenue that they had the potential to recognize in 2024. So debt, they repaid a little bit back, but they did not take out any new debt. And coming down to their cash flow, I was really curious as to why that cash balance decreased so much. You can see that their cash from operations had a very healthy 12.8% increase year over year. So why is that cash down so much? Well, let's look at the financing part first. So that's down from last year. Last year, they did $1.4 billion in financing, which was mostly share repurchases. And this year, they only did just under $1 billion in financing activities. A lot of that was share repurchases that did slow that down quite a bit in the second half of 2023. But the biggest number that stands out is in their investing activities. $800 million versus last year of $80 million in cash used for investing activities. So what is that? The first thing I want to point out is on their 9 months ended September 30th, 2023 cash flow statement, the cash used for investing activities was right about $70 million for the year. So that increase all came in Q4. So what did they do in Q4 that led to such a huge cash outlay? The answer is acquisitions. So what they did was they acquired the remaining 66% of the Burgiss group. They already had about a 33% stake in Burgiss group. That remaining stake cost them nearly $700 million in cash. So that essentially accounts for that massive cash outlay in Q4. Now, this announcement was on the 14th of August in 2023. However, Jim Kosis, CEO of Burgiss, said that the acquisition closed in the fourth quarter of 2023, and it was expected to generate $90 million of revenue in 2023. I do think that large increase we saw in revenue, nearly 20% year over year, was due to the addition of Burgiss to MSCI. They also announced 2 other acquisitions in Q4 of 2023. The first is Trove Research, which is a climate solution firm. However, in this acquisition, the CEO did state that they don't expect a material impact to their cash outlays. And also the acquisition of Fabric, which is a technology platform specializing in portfolio design, customization, and analytics for wealth managers and advisors. Again, this should bolster their analytics division in MSCI. MSCI also said this is not a material impact on their cash outlay. So moving on to my valuation update for MSCI, let's look at their projections. Their year one estimates are pretty much in line with the management guidance for 2024. MSCI does a very good job of meeting their guidance. So they're projecting revenue of nearly 11.8%, a 53% operating income margin, 40% net income margin, and then free cash flow, I'm guessing on the low end of about 1.2 billion. Going forward for the next 10 years, I'm using analyst projections, and then I'm knocking off a few basis points from there. So that gives us a compound annual growth rate for revenue of 8% and a compound annual growth rate for free cash flow at nearly 10%. I'm expecting that margin for free cash flow to expand to about 54%. And I'm also expecting net margin to expand to about 48% and operating margin to expand about 57%. Like I mentioned earlier, MSCI pays a very good dividend. With that 15.9% dividend increase they announced in Q4, we're looking at a dividend for this year of $6.40, an increase of 15.9%. Going forward, I'm projecting a 12% year-over-year increase for dividend, and with a perpetual dividend growth percentage of 7.25%. That gives us a dividend discount model price of $939.40. To me, this is very conservative for their dividend. If you look historically, their dividend has been increasing the last 5 years at least 20% per year. So what does their final valuation look like? Well, before getting into that, let's look at their return on invested capital and return on capital employed. Very strong numbers, 27% for ROIC and 36.62% for ROCE, well above their 5 and 10-year averages. I point this out because it demonstrates the skill of management's capital allocation ability. With the acquisitions they had in Q4, I expect this number to either go up or at least remain the same. All right, so looking at their discounted cash flow, using those growth rate and free cash flow projections, I get a discounted cash flow price of $467.84. That's based on a discount rate of 8% and perpetual growth rate of 3%. Like I said before, my dividend discount model is $939.40, and my exit multiple is at $501. My comps for this are S&P Global, Moody's, FactSet, and CME Group. So right now, MSCI is having another good day in the market. They're trading at $606.96. Yesterday, they had a huge pop when they released their earnings, up to over $600 from a $550 starting point. So over a $50 increase in their share price just in one day. And with my valuation average of $594.02, that actually gives us a potential downside here of 2.13%. When we put in a 10% margin of safety, our acceptable buy price becomes $534.62. To me, what this means is that MSCI is actually pretty fairly priced in the market right now. And if we want to get really good value out of this stock, we'll have to wait a little bit for that price to come down if we want to generate these types of returns for ourselves, those 30% annual returns. Right now, you might get a good return if you buy it, but you're not going to get a great return. However, MSCI is a great compounder and will provide a lot of growth for any portfolio for years to come. So before we go, I do want to emphasize that this is not financial advice, and I do own a stake in MSCI. With that, thank you for watching today's video. And what do you think? Is my analysis of MSCI reasonable, or am I being too conservative? Also, please hit that like button and don't forget to share this video. And if you found this content helpful, please consider subscribing to this channel and joining our community. Thank you and happy investing.